Hello again, and welcome back to our study of accounting.
The process of a student at this point in time, identifying a transaction and then trying to analyze and prepare what I'm going to call a journal entry to show the accounts that are affected and whether those are affected with increases or decreases will help you to better understand what a business is all about. So we're going to do that, and the general form that we're going to use for manually prepared journal entries looks something like this. We will first show any account, asset, liability, owner's equity, revenue, expense, dividend, whatever that transaction involves, and if in fact there is a debit to that account, then we're going to show that first and designate it this way. If in fact we have, and we will have, accounts that are being credited, we will indent the name and then show that on an indented or in another column to the right. Okay, now let's actually try and prepare some journal entries for some basic transactions. And if you don't mind, and go through each of the transactions, now let's record them in a journal entry. Was that he put $100 of his own cash into the business. From the business's separate entity standpoint, if we analyze this transaction, assets increased. The asset was cash. The company has no future obligations. What we have here is owner's equity being increased as a representation of the amount of cash provided by owners through a capital contribution, referred to in this case as capital stock. Remember that the right-hand side of the equation really explains how we got the cash. Did we borrow it, or did owners provide it? In this particular case, we received cash from the owners, and we show that over here in owner's equity under capital stock. How would we record this transaction in a journal entry form? Well, first, let's look at cash. Cash is being affected. It's going to have to be reflected in the journal entry. But is it going to be a debit or a credit? Well, cash is an asset, and all assets are increased on the left-hand side or debit side. So we'll show cash, a debit for $100. Owner's equity is also being increased, and increases in owner's equity, capital stock in this case, are increased on the right-hand side. Now we'll go ahead and record capital stock, and we do that by indenting it and showing it on the right-hand side here for the number. That is the journal entry. It is a very simple expression of what happened. We received cash and it was increased. We must have received it from owners because we're increasing owner's equity, capital stock. Let's look at the second transaction. We had an increase in an asset, cash, and an increase in a liability because it now has an obligation to transfer assets, cash, in the future back. How much? In this case, $200. Cash is increased on the left side, so cash is debited. We show that here in the journal entry. The liability, notes payable are increased on the right-hand side or the credit side. So we indent notes payable and show $200 credit. This journal entry is really a shorthand expression of a transaction of a business. Let's do the next one. C. He decided to leave $75 in his pocket, $225 down to the local store, and bought some candy. Heck, that's the business. He's buying candy and then hopefully selling it at a higher price for a profit. In this particular case, he bought some candy, which we referred to as inventory. The definition of inventory is goods purchased for resale, and that's what's happening here. We do have a new asset coming into the business. These goods held for resale, this inventory, the candy, actually has future benefit to The definition of an asset, you'll remember, are property, which inventory is, or rights, that have probable future benefit. The future benefit of inventory is it can be sold, hopefully at a higher price and a profit. We have a new asset coming in, inventory, but we're also giving up an asset, cash, the amount of $225. If we were going to actually prepare a journal entry to record this transaction, we would show inventory and asset increasing. Assets are increased on the left or debit side. So we show inventory as a debit. And then the cash, also an asset, is decreased, and decreases in assets are on the right hand or credit side. You'll remember that in this transaction we incurred no additional obligations, and the owners of the business didn't provide any additional assets or resources. All we were doing was changing the form of our assets from cash form to a form of cash and inventory, which hopefully will make us a more productive business in terms of generating a profit. Now let's move on. The next transaction we analyzed this transaction by noting that in fact we were receiving cash, an asset, from our customer of $275. Again, the right-hand side of this equation really explains how we received that cash. In this particular case, we didn't borrow this from the customer. We got it from the customer because we sold goods or services. The beneficiary of goods or services sold, and ultimately any profit therefrom, are the owners. The owners are the beneficiaries. And the term that we use to describe assets arising in the business that benefit the owners from sales of goods or services are revenues. Revenues are being increased. Also, we have an asset going out, inventory, $225. The customer took it, it's gone. It's not ours anymore. We must show the decrease in the asset inventory of $225. We reflected this increase in assets as an outflow representing a cost of doing business. It's one of the costs of providing the goods or services to our customers. That is the definition of an expense. And so we show expenses here of $225. This might be a little confusing to you because we actually have this arrow next to expenses might be confusing because expenses are actually increasing. So why am I showing a decrease here next to expenses? The answer is that increasing expenses have a negative effect or a decreasing effect on owner's equity. This down arrow here shows the decrease in owner's equity from increasing expenses of $225 worth. Now, if we were to record this in a journal entry format, we would show cash increasing. That's a debit to cash because increases in all assets are on the left-hand side. Sales revenues are increased, and revenues and all owner's equity accounts are increased on the right-hand side. $275 increase or credit to sales revenues. We also have an asset going out. An outflowing or decreasing asset is on the right-hand side or credit side of an asset account, in this case inventory, so we will show inventory as a credit for $225. You'll notice that I left a blank here to leave room for an account that needs to be debited. That would be the expense account because we have increasing expenses causing a decrease in owner's equity. The increasing expense is referred to as cost of goods sold or cost of goods sold expense. That increasing expense is reflected, as all expenses are as they're increased, on the left or debit side. One of the most common mistakes that students make is that many students will analyze this transaction and record it in the following way, or ways. They'll identify that there is an increase in cash, an asset, and show it as a debit. They'll also identify that inventory is going out, and they'll show it as a $225 credit or outflowing asset. They'll identify and recognize that debits must always equal credits in any recorded transaction, and say that the difference is $50. Therefore, we must have a credit for $50 somewhere. And then they'll think, well, that $50 really represents our profit in the transaction. We're selling this candy for $275 and it only cost us $225. We made a profit of $50. And sometimes students will actually show a credit here to something called profit or net income. But that is a mistake, because profit or net income is accounted for as revenues minus expenses equals net income. Profit is always defined in gross terms through revenues minus expenses. Sometimes students like to put in here the term retained earnings. They know that profit ultimately ends up or should be reflected as earnings retained in the business, at least at this moment, and so many students will simply take the $50 and reflect retained earnings. But again, they have simply identified the profit or net income and not distinguished it in gross terms, in terms of the amount of sales that we made and the cost or expenses of providing those sales. That is so much more informative. Some students sometimes might just reflect revenues and say, gee, our profit was $50 and maybe we'll just call that revenue. But the fact of the matter is that in this transaction, our total sales revenue, and again, revenue was defined as the amount of assets inflowing as a result of providing goods or services to customers, which in most cases is the sales price. The asset that came into us as a result of selling this candy to our customer was cash of $275. That was the sales price. Revenues are reflected in the gross amount of the sales price. So to say that revenues were $50 is inaccurate. The total revenues were $275. This manifestation, this journal entry here to record this transaction is inappropriate. We must show the profit of $50 in terms of the gross revenues, the full amount of revenues, $275, less any expenses associated with providing those goods or services, in this case, the cost of the goods or inventory sold, an expense of $225. The amount of $50 revenue will ultimately be reflected in the income statement, where we show our total revenues minus our total expenses. Now, our last transaction, when he did that, he took resources or assets out of the business for his own personal use. Again, if we're going to distinguish the assets of the business separate from personal assets, we actually have cash coming out of the business and should therefore need to show a reduction or decrease in cash of $10. We're not paying off any obligations. The only obligation we have is a note payable to Dad for $200. What we're really doing is giving some of the owners either their money back or a distribution of some of the earnings that are currently in the business held on behalf of the owners. We call this a dividend, and the effect of increasing dividends is to decrease owners' equity. So even though we have increasing dividends, the effect on owners' equity is a decrease reflected in the arrow. Okay, let's prepare the journal entry. Again, cash in this particular case is going out. A decrease in cash is, well, cash and all assets are increased on the left or debit side and decreased on the right or credit side. So we're going to show cash as a credit, and you can see that I'm indenting here first cash because, well, it's easy to identify. Now, in this transaction, I know that there must be a debit to $10 because debits always equal credit. The question is, what account is debited? Well, the only other account affected in this transaction is dividends. It was an increase in dividends, which has a negative effect on owner's equity. I've memorized that increases in dividends are accounted for on the left side or debit side. So this debit for $10 is reflected or recorded in the journal where we're recording these transactions as a debit.